What is the federal funds rate? The federal funds rate is determined by the Federal Open Market Committee, FOMC, of the Federal Reserve, Fed. It is the rate at which banks lend money to each other, usually overnight, to maintain their reserve requirements. In simple terms, the federal funds rate is the rate that banks charge each other for short-term loans. How does the federal funds rate affect loans? When the federal funds rate is high, loans become more expensive. This happens because banks pass on the increased cost of borrowing to consumers and businesses. Therefore, financing options, such as personal loans, mortgages, and lines of credit for businesses, become more expensive and less accessible. Currently, the federal funds rate is at 6.75% per year, the lowest in recent years. This means that the cost of borrowing is relatively low, encouraging consumption and investments. Practical example. Imagine you are considering a personal loan of $10,000 to renovate your house. If the federal funds rate is high, say 14% per year, the bank may charge an annual interest rate of 20% on the loan, resulting in higher monthly payments. With the federal funds rate at 6.75% per year, the loan interest rate could be 12% per year, making the monthly payments more affordable. Impact on inflation. Inflation is the generalized increase in prices of goods and services over time. When inflation rises, the purchasing power of money decreases. To control inflation, the Federal Reserve can increase the federal funds rate. How does the federal funds rate control inflation? By increasing the federal funds rate, the Federal Reserve makes credit more expensive and consequently discourages consumption and investments. With less money circulating in the economy, the demand for goods and services tends to fall, which can help control prices and reduce inflation. Conversely, when inflation is low, the Federal Reserve can lower the federal funds rate to stimulate the economy, making credit more accessible and encouraging consumption and investments. Practical example. If inflation is at 10% per year, the Federal Reserve might decide to increase the federal funds rate to 8%. With the higher federal funds rate, loans and financing become more expensive, reducing consumption and demand for products. This can help control inflation, bringing it back to lower levels. Difference between inflation and federal funds rate. The difference between inflation and the federal funds rate is crucial for determining the real gain of investments. The real gain is what truly matters to investors, as it shows how much they are earning above inflation. How to calculate the real gain? To calculate the real gain, you subtract the inflation rate from the federal funds rate. For example, if the federal funds rate is at 14% per year and inflation is at 10% per year, the real gain would be 4% per year. 14%, 10% as 4%. Practical example. Imagine you invested $1,000 in a government bond that pays the federal funds rate. If the federal funds rate is at 14% per year and inflation is at 10% per year, after 1 year, your investment would have earned $140, 14% of $1,000. However, the 10% inflation means that the prices of goods and services increased by an average of 10% in the same period. Therefore, the real gain on your investment would be $40, $140, 10% of $1,000, or 4%. What is the prime rate? The prime rate is the interest rate that commercial banks charge their most creditworthy and low-risk customers. The prime rate is directly influenced by the federal funds rate and is fundamental for understanding the returns of various types of investments and loans. How is the prime rate calculated? The prime rate is generally defined as the federal funds rate plus a margin, which is typically 3%. Many financial applications, such as personal and business lines of credit, have their returns tied to the prime rate. Practical example. If the federal funds rate is at 6.75% per year and the margin is 3%, the prime rate would be 9.75%. If you have a business loan that charges 1% above the prime rate, you would pay 10.75% per year on the loan amount. Federal Deposit Insurance Corporation, FDIC. The Federal Deposit Insurance Corporation, FDIC, is a government entity that protects depositors and investors in the United States financial system. The FDIC insures up to $250,000 per depositor, per institution, in case of bankruptcy or intervention of the institution. Importance of the FDIC. The FDIC is crucial for providing confidence to investors, especially those investing in smaller banks that offer better returns. With the FDIC guarantee, investors know that even if the bank fails, their investments will be protected up to the insured limit. Practical example. Imagine you have $300,000 to invest. To ensure all your money is protected by the FDIC, you could distribute your investments among 3 different banks, investing $100,000 in each. This way, if any of these banks fail, you will have the FDIC guarantee to recover your investment. Useful and easy to follow tips. Diversify your investments. Don't put all your eggs in one basket. Diversifying your investments in different assets and financial institutions can reduce risks and increase the chances of achieving good returns. For example, you can invest part of your money in treasury bonds, part in certificates of deposit, CDs, from different banks, and part in investment funds. Monitor inflation and the federal funds rate. Keep an eye on inflation rates and the federal funds rate. These indicators directly influence the purchasing power of your money and the return on your investments. For example, if inflation is rising, it's a good idea to seek investments that offer returns above inflation to protect your purchasing power. Use the FDIC to your advantage. Take advantage of FDIC protection to invest in smaller banks that offer better returns. As long as you respect the $250,000 per depositor per institution limit, your investments will be secure. For example, if a smaller bank offers a CD with a return of 120% of the prime rate, you can invest up to $250,000 in that CD, knowing your investment is protected. Consider the prime rate in your investment decisions. The prime rate is an important reference for various investments. Before investing, compare the rates offered with the prime rate to ensure you are making an advantageous choice. For example, if one CD offers 90% of the prime rate and another offers 100% of the prime rate, the second is more advantageous, assuming both have the same level of risk. Plan your financial goals. Have clear financial goals and a plan to achieve them. Set short, medium, and long-term goals and choose investments that match these objectives. For example, if you plan to buy a house in 5 years, consider investing in treasury bonds or CDs with a maturity aligned with that time frame. Be prepared for changes. Economic and financial conditions can change quickly. Always be prepared to adjust your investments as necessary. For example, if the federal funds rate rises, you might consider investing more in treasury bonds that follow the interest rate. Continuous financial education. Continuously seek to learn about finance and investments. Financial education is a powerful tool for making informed decisions and maximizing your returns. Read books, watch videos, attend courses, and follow economic news to stay always updated. Understanding the federal funds rate, its impact on inflation, the difference between inflation and the federal funds rate, what the prime rate is, and the importance of the Federal Deposit Insurance Corporation, FDIC, is fundamental for making informed financial decisions. With this information, you will be better prepared to invest safely and efficiently, maximize your returns, and achieve your financial goals. Always remember to diversify your investments, monitor economic indicators, and seek continuous financial education.